thank you very much for the invitation and the Bank of Israel for this webinar. So it's a pleasure to present this book, although, the book is pretty extensive and it's hard to present the book in a seminar. So let me say a few things. As you say, it's my first book. We usually don't like to write books, so we usually write papers, but it turned out that I started this project thinking about a textbook, but I think it has become a bit more than that, and it's a bit of more comprehensive. And that's the cover of the book. So what it does, I think, what I wanted to offer there is a unified framework for thinking about monetary economics. And I cover many topics, but today what I want to spend my time with you is to discuss mainly few issues which I think are very important and perhaps motivated the subtitle of the book, Foundation for Modern Currency System. So what I want to discuss is two concepts, the concept of currency and the concept of money. And these two concepts are, I think, in my view, fundamentals for understanding modern monetary system and, in particular, the power held by central banks. So it's not going to be a very technical presentation, but and I hope it's something. I like to present these things because usually I discover it's something new or something we haven't paid much attention. And the question I start is, what is the dollar? For example, what is the euro? What is your currency? The new shekel, I guess, right? And that's the question. And I think it's not an easy question to answer. And in my view, and in my journey, it took a bit of time to be able to answer properly to this question. And in particular, in a system in which currency has no longer an intrinsic value. So we're talking about worthless currency. So what is currency? I'm going to define it, and this is not going to be a definition per se, but it's a liability. So currency is debt, is the liability for the issuer. And let me just go back into the history, showing you some coins. And because it is a little detour historical, although I'm not a monetary historian or an economic historian, it's helpful, I think, to understand how currency has changed and how the currency system has changed. So, for example, I just wrote yesterday a blog on my Substack, and I was talking about these coins, which is the Florentine florin. And this was a coin circulated in Italy in the 13th century, started to be minted in 1254, and is the coin of the Republic of Florence. And is well identifiable for, I think, 2 or 3 reasons. First reason, you see the emblem of the town, which is the flowers on the right, the Gino, and on the left there is Saint Baptiste or something like that. And this is 1 florin, and the characteristic of that, it was a gold coin of a particular weight, which was around 3.5 grams. So at that time, you could clearly identify a currency with, coin, the portrait that he had, the emblem, what it was printed on the face, on both faces, and the metallic content, okay? And in some way, the currency was carrying itself the promise that he had. And the promise was that gold, inside. And well, abuse of money has a long history, but this coin was successful because the issuer didn't debase much the coin, so always maintain the metallic content, and at the same time also the alloy, in some way the mixture between gold and zinc. Zinc was useful to melt the gold and make it a coin, and this alloy was particularly stable over time, and the purity, the fineness of the coin is something which was very difficult to ascertain. So that was a good property. And this made the Florentine florin the dollar of the Middle Age. Now, the system has evolved in the way that, and I'm going to jump, for example, to the dollar in the gold standard, has evolved because it became a system of paper money. But you can see here, this is a dollar, a $10, let's say not bill, but $10 in gold coin, which is issued in 1922, 23, something like this. Yes, 1922. And I think you can see here up, which is very important. This certify that there have been a deposit in the Treasury of the United States of America, $10 in gold coin, payable to the bearer on demand. So this information, I think, is quite amazing, because we moved from a system of money, metallic currency, to a system in which there was a sort of paper currency, but in which the paper currency was a debt of the issuer in terms of a commodity. In this case, the $10 in gold coins. You can see that it was a debt because the bearer had the right to receive $10 in gold coin. And what was the dollar at the time? It was quite clear. The dollar was a certain amount of gold. Okay, so there was a certain proportion, I think it was $1, 1 gram point something, of a dollar with respect to gold. So the definition of the dollar in the gold standard is in terms of gold. And, this sort of paper currency was a debt of, in particular, the treasury, okay? So it's important, and this is something connected to the recent events, that this is a debt of the treasury, okay? Now, things haven't changed much with respect to this when we look at so let me think, sorry, let me just, haven't changed much when we move to the Bretton Woods system. For example, here we have a silver certificate issued in 1957, and this certificate certifies that there was on deposit in the Treasury, again, the Treasury of the United States of America, $1 in what? In silver, in this case, was a silver certificate. So there was a conversion between the dollar and the silver, payable to the bearer on demand. Again, this was something, a debt for the treasury, okay? Bretton Woods collapse, 1971, and then we have the new dollar, and is something different. As you can see from the banknote, there is no longer the treasury, although the treasury is just signing the bill. This is the $1 bill. It's a Federal Reserve note, okay? So now it's something, it's a note of the Federal Reserve. It's a debt of the Federal Reserve. But nothing is said. It is just $1, right? And it doesn't tell us anything. Here there is this note is legal tender. But if you go back and people think, oh, this is something important in the system in which currency is intrinsically worthless. No, it was also there. This was a legal tender. Okay, so let me jump to another bill, which is more instructive to the definition of what is a currency. And this is the Bank of England recent, for example, banknotes. And let me enlarge it. And you can see here that there is a promise again. So it's a debt. It's a promise. This is a £5 banknotes. The promise is to pay the bearer on demand the sum of £5. Okay? So a banknote of £5 is nothing more than a promise to pay the bearer on demand the sum of £5. So that's a big change, right? Before it was a debt in terms of gold or in terms of silver. Now is a sort of circuit here, and I can stop my sharing and be live with you. Here is a sort of debt, which is of a particular form. Is a promise basically to pay in units of itself. A $1 bill is nothing more than a promise to pay $1. So this definition underlines that currency still remains a form of debt, but a very particular one. It's a sort of claim that promises repayment in units of itself. So the obligation is in some way circular and at the same time is precise. So the issuer, whatever central bank we have now, and also I'm going to include in this definition also cryptocurrency, is nothing more than promising to repay $1 with a $1, €1 with €1. And the same is true for any currency and also for your currency. And even for cryptocurrency. So what is the currency is basically now defined by the liability of the issuer, okay? So it's no longer something which is going to be redeemable in something metallic, in gold, is a precious metal, is something redeemable by itself. And this has several implications, okay? So first implication, which was not the case in the gold standard or before, the first and important implication of a currency defined in this way and the current currency circulating is that the currency liability are default free. So there is no issue of solvency for the issuer. The central bank or even the private issuer doesn't need to raise any resources to meet its obligation, as these resources can be repaid with the same currency, basically. And this is in sharp contrast with the commodity standard, where the issuer had to deliver something of intrinsic value. Okay, so this gives a lot of power to the central bank. Exactly, the default-free nature of currency liabilities, I'm going to argue, is going to be the key aspect for why the central bank is not a regulator in the system, is a central agent in the system. So first property, default-free nature of the liability of the central bank. And corollary of this is that to function, a modern currency system doesn't need to require the issuer to hold any asset or equity. Currency can be simply distributed or dropped in the system. Okay, so there is no requirement for a currency system to have the central bank to have asset or to have any equity. From a modeling perspective, I think some of you remember some old models in which there was central bank was modeled as MT equal to MT minus 1 plus transfer. Yes, that's drops of money into the system. And that's exactly like, for example, Bitcoin are drop into the system. Okay. So, and the issuer balance sheet, I'm arguing, can consist solely of non-interesting bearing liabilities. For example, can be digital token or cash. And that's one representation of a currency, just non-having interest on it. But there can also have interest on it, like can be reserves, as they're called. But even in this case, when central bank issue reserves and pay an interest rate on reserves or any other liabilities, there is no issue about solvency. It's not a concern. The issuer can always meet those obligations. So third point. So second point was no problems in terms of asset or equity. Third point is there is no trade-off for an issuer of a currency between setting interest rate on its liability and instead choosing the quantity to borrow. This is very special. And again, this comes from the fact that the currency is nothing more than a claim to itself. So in some way, the issuer doesn't face the market. He's going to affect the market, actually. So he can set independently prices and quantity of the liabilities. And this is very different from any other debtor in the economy. Central bank is a debtor, but of a particular form. A debtor that doesn't need to obey to market, can just set interest rate as they want and can set reserves quantity as they want. Fourth implication of this is that when the central bank set the interest rate on reserves or on its liabilities in a short-term way, maturity, is basically fixing the lower borrowing rate available in the market. And this is by absence of arbitrage opportunity. So there is, again, no need of having open market operation, assets, or any other balance sheet consideration. They can just set the interest rate on reserve and in this way affect by arbitrage opportunity, absence of arbitrage opportunity, any other risk-free interest rate in the market. So that's the key of the transmission mechanism, channel of monetary policy into the system. So fifth point, default-free characteristic, no particular problem of solvency, no relevance of asset or equity, possibility to set interest rate on reserve and quantity independently, setting the interest rate on reserve and affecting the market interest rate. All these features tell us an important things, that when we think about price stability or price control, then the central bank can play a role in this because it's the issuer of the currency. And the price is nothing more than, so the inverse of the price is nothing more than the value of the currency. So there is some hope that the central bank can really affect the price, okay? So I think this may be not surprising to you, but there are theories that tell us that, for example, fiscal policy can have a role in controlling the prices, and that the treasury or fiscal policy are important in anchoring the price level. I'm going to argue that this is not necessary, so that we can have currency system without any involvement of the treasury. And actually, this provides most of the time a good shelter with respect to interference from fiscal authority, and in particular, interference that can affect the control of the price level. Okay, so let me address, given this introduction, I would like to tell you how the central bank can control the price level by its own. And I think I've in some way persuaded you that the central bank has a special role in the system because define what is the currency. Currency is a claim to itself, and this brings a lot of powerful properties and powerful tools already to the central bank. Now, when I and I also told you that, it doesn't matter whether you have asset, whether you have equity. Yeah, those things are going not to matter for the functioning of the currency system, but they do matter when we are going to talk about control of the prices. Okay, so for example, I give you an example that, suppose we live in a Bitcoin world. That's the only currency in circulation. And this is a non-interesting bearing currency. It's basically created by dropped people. It's now dropped to miners, right? It's just a way to distribute it to some people. Okay, just drop it there. It's a transfer. It's MT equal to MT minus 1 plus the transfer. And that transfer goes to certain people. Now, at some point in time, Bitcoin, they're going to have a constant supply, and it's going to be, I think, 2,130. And this is going to be constant at 21 million afterward. And the question is how that currency is going to be valued. So is a constant supply of currency making the Bitcoin value determined? In some way, is the constant supply of currency able to determine the price level? And understand that if we live in a Bitcoin world, and we can live in a Bitcoin world, there is just liability for the issuer, just these tokens distributed. Those is the liabilities, which is going to be the asset for the holder, okay? And the issuer doesn't have any equity, any asset, anything, okay? So how can we determine the price? Now, there is no constraints on the central bank, but there are equilibrium constraints in any model that we write. And an equilibrium, let's say, relationship that is going to come in this ideal world that they have underlined is that when there is full capacity in the economy, real resources cannot be created from nothing. So basically, that nothing is currency, right? The tokens, these tokens are nothing, right? It's digital things. It's even if it was paper, it's nothing. So you can create real resources from nothing when the economy is at full capacity, okay? So that's an important concept. And when the economy is not at full capacity, you can have room, to create something. But when the economy is at full capacity, you can't create real resources. So the question is, I issue tokens, there is going to be 20 million of Bitcoins out there. And if the price is not infinite, it's going to be finite, that 20 million token is going to worth something, right? This is a real stuff. So from tokens, we have something real. So the question is how this can be an equilibrium. So which prices are going to be in equilibrium given a constant supply of digital tokens which are worthless? That's, I think, is one of the key questions in monetary economics. And sometimes we bypass those questions, right? Or, people have focused on those questions, and there is a lot of controversy there. But here I'm telling you, there is a tokens supply there, and if there is an equilibrium price which is finite, those tokens are going to have a real value, okay? So how that can be an equilibrium? So first things, when we live in this type of ideal world in which we have a constant supply of tokens, then this is basically ruling out the possibility of a permanent deflation. And the proof is simple. So if the supply of token is constant and prices in equilibrium goes down at the rate beta, usually in our models. So there is a deflation. This real stuff is going to blow up, right? So it's going to be finite when I'm going to look in the limit. Cannot be an equilibrium. So in a Bitcoin world in which the supply of token is constant, there is no deflation in equilibrium. Okay, so, and that's already telling us something. Oh, a constant supply of token is something about monetary policy. So that policy can eliminate deflations. Okay, first things. Now, there can be other prices that can be, for example, inflationary, right? And instead of falling the price can increase, even if the supply of token is constant. And this can be an equilibrium. Now, even in this ideal world, it could be possible for the constant supply of token to completely eliminate the possibility of inflationary path. How? Well, I told you, we have this token there. Suppose that they have a real value. In the economy, in equilibrium, that real value is a real asset for the holders. It means that there should be something which is a cost for the holders that is going to compensate the real value of those assets. So, and again, this go back to what I was telling you before. There is no real resources that can be created for free in a monetary system. So what is the real cost? The real cost is the foregone interest rate from holding non-interest bearing tokens. If the non-pecuniary benefits of holding currency are essential, then this cost is essential into the system. So basically, you can have the benefits of this real asset into the system are completely offset by the cost. And that benefit and cost that are aligned only at a certain price level. And this become the price level of the equilibrium. And this price level can be also a constant price level across time, okay? So very loosely, I have proved that if you have a constant supply of tokens, like Bitcoins, worthless token, no equity, no asset for the currency issuers, there can be perfect control of the price level, okay? Now, where does control come? As I told you, the key part is that you have asset there, they are real. There should be some cost for the holders. And this cost comes from the interest rate that you give up when you hold tokens, right? That's the opportunity cost. Now, if you think about a system of currency competition, those sort of implicit rents are going to be wiped out by competition. You know, I can create tokens which have different characteristics, for example, giving the holder a little bit of interest rate. So this is going to get rid of Bitcoin from the system and move people from Bitcoin to this new currency, okay? So competition is going in some way to erode all the support I told you about the existence of Bitcoin into the system, okay? So when a token is issued just as a liability, there is no asset, there is nothing else, then you need a cost. This cost comes from sort of implicit seigniorage, although it's not profits from the issuer of currency. Those seigniorage can be eroded by currency competition. So the question is, how can you sustain control of the price level if you have currency competition? And here it comes the importance of a richer balance sheet that can allow you to control and maintain the control of prices in a better way, even if you don't have this, let's say, seigniorage benefit. Now, in the book, and in particular, the first chapter, I discuss, first and second chapter, I discuss a richer structure of the balance sheet for the issuer, like holding commodities, but it is not necessary to have full convertibility. Commodity can be used strategically, either as a trade of exchange with respect to currency or through portfolio operation, okay? So it's not necessary that you have to be in a commodity system, but commodity can help to alleviate the problem I told you. Another element, in absence of monopoly power over currency issuers, is holding asset of good quality, free of default risk, and also maintaining a positive net worth, so that in some way enables the issuer to allow for positive remittances or real remittances, nominal or real, that can be an angle. So let me just recap a little bit what I say until now, if there are no questions. So first, for a modern currency system to work, we don't need any balance sheet consideration, any asset, any positive equity for the central bank. But when we work, and we were trying to talk about control of the prices, then those things are important. And what I claim that mostly important is having assets of good quality. If they're nominal, they should be risk-free assets, and perhaps also some commodity, okay? Those elements and a positive equity, positive net worth of the central bank are elements that guarantee, under more general condition and environment, the control of the price level. So balance sheet composition and transfer policy for the currency issuer become essential when it comes to control the price level. And okay, so I think, these observations are quite important because they corroborate what I was telling you at the beginning, that the central bank has a unique power into the system and has a legitimate power to control the price level. In particular, everything I said rests and rely on the fact that the liability defines what a currency is. In what I say so far, and I think that's one of the main takeaway I want to give to you, is that there is no fundamental role for the Treasury in governing the currency or controlling prices. Now, I'm sure you've heard about the fiscal theory of the price level, okay? And, and this is controversial for the reason I think has been not well explained in general. And it makes sense, but it makes sense only in an environment in which the Treasury is guaranteed. The Treasury liabilities are guaranteed implicitly or explicitly by the central bank. But this guarantee is not required at all. So any prescription of the fiscal theory of the price level, which is correct, comes because in the model that we work, there is an implicit guarantee coming from the central bank. How do you see that? So when you write a model, we write usually utility maximization for consumer, budget constraints, and then there is a solvency condition for the consumer. And then we have the consumer problem. Then when you go to the government, most of the time people integrate central bank and treasury, right? And they write a flow budget constraints for the central bank, for the treasury or the government. Okay, and there the liabilities are, treasury debt or, even central bank debt. Now, when you write that constraint, no one never put a solvency condition. you just write that those liabilities are risk-free, right? You always add an interest rate to the liabilities, and this is the risk-free interest rate, okay? But there is no solvency constraint. And why? Because what I say so far rationalize that. The liabilities, if those are liabilities of the central bank, do not need to have a solvency constraint because they are default-free by definition. So that's why you don't write a solvency constraints there, because you just write they are risk-free. And you can do that. But you can't do that when you write the treasury budget constraints, because those liabilities are instead maybe defaulted, right? For example, US debt was downgraded. Why was downgraded? It means there is a solvency issue, not big, but there is a solvency issue. So in the model, you have to write that. So in general, we don't do that because implicitly we are integrating, consolidating central bank liabilities and treasury liabilities, considering them all together. And you don't need to write if you do that, solvency constraint. So the fiscal theory is based on this assumption of the consolidation of the balance sheet of the central bank and the treasury. And then you don't write the solvency constraint. But then what you discover that, well, when you need to determine the prices, you need the tax policy of a particular form. But that tax policy is only feasible if the central bank is guaranteeing the treasury. Otherwise, you can't do that. And this is explained in the book in my first chapter. Okay? Any questions?
Yes, we have a question from Anton Moisev.
Okay.
Yes, please go ahead, Anton.
Yeah, thank you, Anton. A very quick question. How did treasuries did all that before the central bank? The central banks are a recent history, right?
Right. Oh, well, because as you saw before, when I was presenting, I was showing you those old paper-backed currency. It was the treasury issuing those currency. For example, for the United States. So in all times, there was no distinction between treasury and central bank. Actually, dollars were issued by the treasury, not by the central bank. It is after Bretton Woods that things have changed, okay? And there has been a sort of separation, right? Which is not so deep in the United States, but for example, in the recent European Monetary Union, the construction of the ECB is separated from the treasury, okay? And when you think about private currency, they're legitimate currency. They are legitimate currency respected, that respect the same definition I gave you before. They are paid by themselves. And those currencies don't have any connection with the treasury at all. They are currency legitimate. Okay.
Thank you very much. We have a question from Pavel Shmatnik.
Just regarding one of the early examples that you gave at the beginning of the talk, you mentioned that the florin was a good currency because it wasn't debased that much, right? So sure, in retrospect, it was good because it wasn't debased, but from that point in time, forward-looking people would trust it because it wasn't debased that much, right? So I understand the point of the you don't need to consider insolvency because when currencies disappear, it's not exactly the same as a default, right? So I'm wondering, where does that element of the credibility of the currency, and again, looking forward, not backwards, where does that factor in something like the fiscal theory of price?
Okay. So the florin was rarely debased, and actually the episode in which was debased is because it was there was more supply of foreign currency into the system. There was a risk of deflation, and in some way, they were issuing more and debasing a bit. It was quite never touched in terms of the integrity. Okay, so the alloy was constant, and that was the purity, fineness. So that was important. And they didn't. So the other important things which I brought in this post yesterday on my blog is that they never, except when Florence lost his power, they never debased the currency for fiscal purpose. Okay. While other coins were circulating, gold, and were debased because the issuer needs fiscal financing needs. Okay, so the fiscal issues has been always there, right? And in particular, you know, you may remember that episode of commodity paper money. There was a period in which there was a fiat money, especially under the Civil War. Those were periods in which there was the abandonment completely of the convertibility. Okay, and why? Because you need to finance the war. Okay. Now, one important aspect is that the florin was carrying the promise. The promise of the florin was 3.54 grams of gold. Okay, so that was the promise. It was carried. It was intrinsic, right? And but it was not a promise in terms of purchasing power. That's important. So when we, and I'm going to go to this point, when we talk about store of value, we don't talk about purchasing power. We talk about promises. Okay? Usually people think store of value, oh, it maintains the purchase in terms of goods. Now that has to do with the prices. And the Florentine florin was keeping the promise in terms of gold, not in other commodities. Okay, that was the promise. All right. And that was important in some way. The basement, as you say, was a default. In some way, was like reducing the amount of gold that the coin had, or even reducing the purity was a sort of default, right? Okay, because you had the gold of not the same quality. So it was not maintaining the promise. So now we are in a system in which any currency maintains the promise. A dollar is a dollar. A Bitcoin is a Bitcoin. When I am entitled for a Bitcoin, I'm entitled to that. If I have the key, the private key, that's my entitlement. When I have the dollar bill, that's my entitlement. If I break the dollar bill, can I go to the bank? I can go to the bank and get it back. Okay, that's exactly, remember, the £5 sterling is the promise to receive £5. Okay, nothing more than that. Okay, so those are basically the promises are itself always validated in today's currency. Clear? Now, when we talk about price level, we need the currency, which is worthless and is worthless, needs a real backing. Okay? So the concept is still the same. You need a real backing. Now, I hope I persuaded you that you can have this real backing even if you don't have the treasury. Okay, so theory that tell you, oh, you need a treasury to have a good currency, is not necessary. But if the central bank guarantee the treasury, then it creates conditions for which the treasury can give back the anchor to the central bank. So, the central bank can be doesn't need to have asset, doesn't need to have gold. The treasury can back the currency with real taxes. But that policy is only possible if the central bank allows that. Now, if you're in a system like that, that's like going back to the past is one of the reasons of the failures and collapse of currency into the history, okay? Because then the treasury has no limit to spend, okay? And the treasury no limit to spend is going to be at some point in time detrimental for the currency and inflation, okay? All right, so let me...
Pierpaolo?
Yeah.
Yeah, I just have one question from my side. You said previously that when the economy is at full capacity, you can create a value, or resources. My question is it the same? I mean, do you include in this statement the Bitcoin? Because the Bitcoin, you know, is international perspective and does not rely on any government, any credibility. How would you include the Bitcoin in this statement?
Yeah, perfect. You know, I was exactly making that example in a sense. We can live in a Bitcoin system. Yeah, you don't need to, you know, if you have a value for Bitcoins, as I'm telling you, this token have a real value, okay? Suppose there are the only tokens around. It means that in equilibrium, and you have those tokens, for you are asset, right? So you get a real asset from that, but something else in equilibrium should cancel that asset, okay? There should be something offsetting that. That's the concept that in equilibrium, you can't create real things from nothing. And how do you see that? And I'm sorry, you know, probably you wanted to see equation. I didn't want to show that. How you see that? I can describe it is real money balance on the left-hand side equal to the present discounted value of interest rate divided 1 plus IT times real money balances. That condition would hold in equilibrium, okay? And that condition is an equilibrium condition. It's not an intertemporal budget constraints for the Bitcoin company. The Bitcoin company is not having any profits. You just have liabilities. That's it. But in equilibrium, you would see in the model that the real money balances should be offset by the seigniorage, which are not seigniorage for the issuer, it's cost in the system, okay? So that's the key equation to see determination of prices, okay? And there is no taxes there. Okay, so you can show that that equation can actually determine a unique price level under certain conditions, which I think are not realistic, but it can show that. Okay, so this is surprising.
I think the confusion in my mind would be when you say full capacity, for me, it does not mean necessarily in equilibrium.
No, you know, full capacity, I mean, when output is completely utilized, and in a simple model, when consumption is equal to output, right? And output is, so that's what I mean. If you have an economy in which, if you have an economy which is some underutilized resources, you can use currency to get to potential. That would be what the modern monetary theories would say, and I would agree, right? That's I agree. You know, it's in our model. I'm sorry, it's in our model, but it's not something I would support. Okay.
Can you expand this conversation? I mean, why you would not or support the MMT?
Because. Because they're saying they're basically saying if you have underutilized resources, you can print money and spend through fiscal policy, and then it's going to enter to the system, and at some point in time, you're going to get to capacity, but this is going to be inflationary afterward. Second, you don't want to get into the business to connect with fiscal policy. The currency issuer is not that job, okay? And that's what they think. And third, no one has, really perhaps the ability to just stop at the border when this thing is going, fiscal policies would always have the temptation to do more, right? And to use unlimited budget. And another, objection to this is that what you spend today matters for the future and the medium-long run growth of the economy, okay? And unlimited spending doesn't have, and, given to politicians, doesn't necessarily provide good investment for the future in the economy, because at the end of the day, the growth of the economy is given by productivity. And I don't believe this is something the government has a lot of expertise to do much, right? So I wouldn't, money is very powerful. What I'm saying, and they say it is, because they understand this correctly, right? And this comes from what I told you, because these are default-free liabilities, right? You just print them, right? Very powerful. But that's not the role of the currency issuer, to give this power to fiscal authority, okay? And unfortunately, this is what is happening a lot of time, right? Because it's easy for fiscal authority to expand their budget and be financed by the central bank for the reason that the central bank has unlimited power. Okay,
unlimited. So I would not say the unlimited, but
the limit is at some point inflation. Because when you reach capacity, this is going to be necessary, inflation. Okay, so, but the limit, there is no, in general, if the currency is used, obviously people can substitute to other currency, right? But if the currency is used, there is no limit to print it, right? And obviously, if you print it, you can create real resources if they're underutilized, but then at some point in time, you're going to hit the constraint. But these mechanism has always been there in the history, right? Anytime, the collapse of the medieval coins was because then the republic were in need of money, right? So, and when they were instead flourishing was the time in which their coins were not debased, okay? They were not used for financing purposes, okay? So now, we live in a system in which we have private currency, and those private currency can be detached from the government. I'm not saying they're good currency out there, but I'm saying from a theory perspective, they can be, we can rationalize the resistance is also a control of the prices and other things, okay?
Okay. I just, I will give you 15 minutes to conclude, and if you want to introduce a new subject, and then we will go to the questions and answers.
Okay, so let me move to the second concept, which was, I said, I wanted to give you two concepts. One was currency, and I hope I persuade you that the currency is a claim to itself, and it is pretty extraordinary things and gives a lot of power to the central bank. Second things I want to discuss is the concept of money. And currency is money. Money is not necessarily currency. Okay? So to understand what is money, we must reflect on the property that currencies possess, which are listed as usually unit of account, medium of exchange, and store of value. So currency as a unit of account, what does it mean? It means that prices and contracts can be expressed in its term. I would argue that currency being a unit of account is not an essential property. So, for example, we don't see prices denominated in Bitcoin, but Bitcoin is a currency. And even in medieval times, prices were often quoted in units of currency that did not exist. And this was a convenience because it was important to have a reference units when there were more coins circulating at the time. I would say that being unit of account is not essential, but give a lot of power to the currency, right? For example, the fact that the commodity are denominated in dollar, that's very important for the reserve currency, but it's not essentially for a currency. Now, unit of account, store of value. What is the store of value? As I told you, when we go back to the history, the Florentine florin was storing the value, the gold. Okay, that was what it was storing. The store of value was not in terms of horses. Okay. So people that now define store of value, this is purchasing power Bitcoin doesn't have, or actually it has for on a longer horizon, it's more than other currency, but this is not the definition we should appropriately use. Store of value has to do with the fact the promises, and the dollar today is promising to be $1. That's it. So currency, by definition, is a store of value because is a promise to pay you units of itself. So a dollar always remains a dollar. Okay? Now, let me tell you that it's not obvious, right? Not all the debt denominated in currency maintain this property. And that's going to be key for defining money. Third property is medium of exchange. And this is the most important property. It's like, being used, okay? Used as to exchange for goods, as a collateral, and pledge for loans and everything like this. Now, these are three properties. What is money? Money are claims on currency. So claims on currency is a debt. Money is a debt in general, but they're claims on currency that share to some degree the same properties I underlined before. So what other securities in the system have the same properties as currency? Like, what other security we can think make the same promises as currency, like, to keep $1 for $1 in the future? Well, there are not many, right? People are questioning the treasury debts, treasury bills to be payable in the future, to maintain the promises, right? So money are claims on a currency, and who issue money except for the central bank has to deliver that currency. Okay, so for example, Karl Brunner, and it's sometimes useful to look at this great monetary economist in the past, was actually saying that money is a claim to a ultimate money, and the ultimate money is the currency, which actually is the monetary base of the central bank. So when we think about the deposit issued by an intermediary, a bank, this is a debt promising to pay in unit of currency. But the bank doesn't have resources necessary to pay that promise. It has to find these resources. Unlike the central bank, it cannot create the currency. So it must back the currency with asset, with an inflow of currency in the future, and it is applied to any debtor in the economy. So to classify privately issued securities as money with store of value properties similar to currency, we need to assess the balance sheet of the issuer. Only if this balance sheet is scrutinized and is perceived as default-free, those securities can perform monetary functions. And for the central bank, this scrutiny is unnecessary. Now, so once we have security, like, deposit, which you think they're default-free, because in some way they make the same promise as currency, then you can use, and you use them for the same liquidity purpose and medium of exchange that currency has. So basically, currency has this property, money are claims on currency that share to some extent the same property as currency. Okay? They don't need to be unitary account because that's something else. They need to be store of value. They need to be medium of exchange. But the key aspect is that the properties of being store of value have to be scrutinized and evaluated through the solvency and the balance sheet constraints of the agents issuing the currency, issuing money. Now, given this definition, currency is well-defined object, is the monetary base of the central bank. Money is what has the same property as currency. Currency is always money. Money is not necessarily currency. So a deposit is not currency, it's money. Now, what is money and what is not? That is always very subtle. And that subtlety is basically the key aspect and the key feature that has in some way characterized most of the financial crisis in the history. Because, for example, Friedman and Schwartz found that contraction in the money supply were frequently associated during financial crisis, and especially during the Great Depression, okay? And something similar has occurred during the 2007-2009 financial crisis, in which the market at some point in time questioned the soundness of security which were privately issued, which were believed to be safe security. So sort of pseudo currency money, but they became risky. So when trust evaporated, basically the supply disappeared, and this was the collapse of liquidity. Okay, so now the issuer of the unit of account, as I say, can control prices without government intervention, without the treasury support. Now, the issuer of the unit of account can also control liquidity, so currency. And especially, when we think about crises like the Great Financial Crisis, the Great Depression, you may wonder that what happened ex post should have been the standard ex ante. So what happened ex post? Ex post happened that this private security became unsafe, and the central bank came into the system to back those securities, expanding reserves, expanding guarantee of private security. So we had the substitution between private money to currency, basically. Okay. Also, to consider Treasury, U.S. Treasury backed by the Federal Reserve. And this, didn't happen during the Great Depression, and that's lack of substitution, the fact that M2 found by Friedman and Schwartz collapsed during the Depression is an explanation of the power that was not used by the central bank. So the question is, should the central bank issue money or liquidity and avoid that the private sector enter into the business, okay? And this is, again, a very long debated theme in monetary economics, which comes under the surface every time there is a crisis. So, for example, Friedman was arguing at some point for narrow banking, right? Narrow banking, you have basically government, treasury and central bank issuing liquidity, and wherever was privately issuing liquidity was supposed to back it by government debt. So there was a one-to-one backing, but at the end of the day, it was just all government liquidity, because if the backing comes from the government, it's the government backing the intermediary, right? That's one scenario, okay, in which the supply of liquidity is government. For example, this could be also, and I discussed that in the book, a framework in which we have a central bank digital currency in the form of deposit held by agents in the at the central bank. So if we are having deposit at the central bank, is like, our medium of exchange is, central bank currency. Okay, so it's the safer form. It's no longer bank. We don't need to scrutinize anything because they're going to be paid always by the central bank. Okay, so this is a system, central bank digital currency in which we have deposit at the central bank is a system in which basically the supply of what is money into the system can be just government, okay? Obviously, this doesn't prevent, even a central bank digital currency system doesn't prevent private sector to create sort of currency, quasi-currency securities. They can, and when they can, when the central bank doesn't supply much liquidity into the system. How do we see that? We usually see that the central bank doesn't supply much liquidity to the system when there is a liquidity premium. Okay, so liquidity premium is a measure, the higher is this premium, is a measure of the scarcity of the supply of liquidity. Okay. Now, so the question is that the central bank, if it wants to supply the liquidity that the system needs, has to have a large balance sheet. Okay? And now, to have a large balance sheet, although balance sheets are not important for the functioning of the system, but for liquidity purpose, you need to have good asset as backing those liquidity that you issue. So when you issue a lot of deposit as the central bank, you need to have good asset, risk-free asset. And those risk-free assets, they should come from other part of the system, okay? So if the system is not able to create enough securities for the central bank to back liquidity and to provide a lot of liquidity into the system, then the central bank should take some risk. And that risk can jeopardize the control of the price level. Now, so for example, this proposal of the central bank issuing liquidity and backing it by asset was the proposal also of Friedman. And this proposal doesn't require any support by the Treasury. Now, the additional proposal of Friedman, which is also detailed in a novel framework in the book, is when is the Treasury helping the central bank to support liquidity. In this case, taxation is important to provide the supply of liquidity to the system. And you need quite high taxation to supply a lot of debt into the system to provide the system for liquidity. Okay. What I argue, and I want here, we have 2 minutes to conclude, is that this dichotomy, this dilemma, this debate between public supply of liquidity versus private supply of liquidity can be different in the future. And in particular, because we have been lived in a system in which the private supply of liquidity was not well scrutinized, right? So we always had problems in which banks were supplying security pseudo-safe, and they turned out not to be safe at all. And why that? Because their assets were not good, okay? So that money was not store value, was not currency. And the problem was in the asset of the intermediary and in the possibility to scrutinize the asset of the intermediary. What I argue, and this is in the conclusion of the book, I argue that in the future, a system of decentralized verification through blockchain, which is not through rating agency, which were responsible of the too good ratings for security. So decentralized verification through blockchain and data analysis through artificial intelligence would allow people, investors, who are in need of money to understand that this is really money and it's not something which is unsafe, okay? So there will be a future in which private money creation, and not private currency, I'm saying private money creation, could be a good substitute of currency, okay? So concluding, so what I did today, I hope entertain you in a more abstract way about 2 themes. One is the unit of account, and unit of account, issuer of currency, that can be also a private issuer, okay? Second, I've been talking about liquidity, medium of exchange, okay? So medium of exchange, there is no need that the central bank enter into the business of the medium of exchange. That liquidity can be also in the future provided more safely and trustworthy and verified in a more clear way through a new system like cryptography, blockchain, and artificial intelligence. So we can envision a future in which we can have a system in which currency is purely privately issued without any interference of the government. And what are the liquid securities in the system are not issued necessarily in the abundant needs that the economy has by the currency issuer, but they are privately created and appropriately verified. So that the currency issuer, and I'm not talking about central bank, it can be like a private currency issuer, like, very sophisticated and even, computerized. So this private issuer can focus on what is the only objective that the central bank should have, which is control of the price level, without any interference from fiscal and financial sector, which is the source of problem that we have been living under, any currency system in the history.
Okay, thank you very much, Pierpaolo. It was a very insightful and a rich presentation, even if I think there is more in the book. I think about the helicopter money thing, CBDC, and a lot of very interesting models that you thought about. Just if we have some questions from the audience, it's time to raise your hand. I will just ask, yes. So we have a question from Amit Friedman.
Hi, thank you. Central banks have objectives, obviously, And private firms also have objectives. Are those in line with issuing money or currency at all?
Well, we should abstract in some way and think that what do we want from the guy, the central bank, or the private company issuing currency, right? What do we want? And the question is, maybe you have a different preference with respect to me. And these preferences can be accommodated in a monetary system in which we have competition across currencies. So if I live in Israel, I'm not happy about how you manage the currency. I can choose to be in another currency system. So this limitation of giving to citizens, forcing citizens to the currency, is not something that give the citizen the benefits of the currency. And some people may prefer something, some people may prefer something different. I guess what is going to be preferred by most is the stability of the purchasing power of the currency. And if we have currency that maintains that stability, perhaps people are going to adopt and freely adopt. And if there are currency issuers which are set according to those principles, people will go there, right? I believe currency competition is going to be the force driving the decision. You know, there can be bad currency, private, and government currency, right? So I don't want to live in a system in which the fiscal policy had unlimited budget to do expenditure that perhaps I didn't vote, right? Because this unlimited expenditure came from the unlimited possibility of the central bank, for which, in my view, there should be just one objective, which is that to maintain the purchasing power of goods and not to distort expenditure into the system, right? In some way or in another, right? So in a system, you know, that's my preference, but some people may prefer something different, right? The only currency competition may give to this the desired outcome. And I believe, you know, people would agree that stability of prices is what the central bank should be focused. And if the central bank are unable to deliver on that, then maybe a foreign central bank can do that, or you know, a private central bank can do it according to some, you know, particular design. Right? And you know, the book is about very agnostic in some way. You know, you can design control of prices by having private currency, not necessarily treasury-linked currency or government currency.
Okay. Amit, do you want to continue, or is that okay for
Thanks. No, I would like to leave time for others. Thanks.
Thank you very much. We have a question from Akiva Offenbacher.
Hi. Do you hear me? Yes.
Yeah, I can hear you well.
Okay, good. Fine. So I have two questions. First question is, it wasn't clear to me why you think that the private provision of currencies will be more successful, reliable, safe than government provision, given, you know, the history is long ago, because there haven't been private provisions of currencies at the national level for a long time. But and how do you view who's going to do oversight? How you know, I mean, Bitcoin has been remarkably trouble-free. I'm not talking about the exchanges. I'm talking about the inner workings of the Bitcoin system and solving the Byzantine generals and all that. So, but who knows in the future when it becomes really important, not as a speculative asset, but as a medium of exchange on a day-to-day basis. When you buy a bottle of milk with Bitcoin, What's going to, and along with all the other, Johnny-come-latelys who are going to come into the picture, the entry, why do you, it wasn't clear to me why you think it's going to be better in terms of, stabilizing prices. And the second question is about the general question about the provision of credit in the system. If you have what's basically a ring-fenced system. I had a paper in 2014 where I said, here's an opportunity to do 100% money in the Chicago plan with the Bitcoin. But the question then becomes, what's going to replace the bank provision of credit, including not just mortgages to small households, but the whole money market system where YPF can play. Somebody can sell $100 million YPF bonds in a couple of minutes with in the New York financial market. What's going to replace that?
Okay. Those are very good questions. And I'm not advocating or necessarily that the prevailing currency would be private. It could be some from standard central bank. But I think if you look at the history, it should be some currency that has a bit of disconnection between treasury and central bank. Okay, and I don't know whether it's easy to find that, but it could be that the discipline that can come from competition from private currency can create also better future government currency. Okay, but it's a question of competition, right? If people trust Bank of Israel or trust that they're going to deliver the promises, right? It's a question of delivering the promises, and it's the question of return. The return is the purchasing power of the currency. So if people are allowed to choose, they would choose according to certain criteria. Maybe this is going to discipline government currency.
I'm sorry, the return to society is the purchasing power, but the return to a private issuer is ripping off the capital. Sorry to put it that way. Return to the private issuer is not the price stability.
Yeah,
I think
that's the problem. That's the problem when we have monopoly. So when there is competition, those benefits are going to be eroded. So you have incentives to provide a good backing. So the example I was making is you can back with seniorage, but seniorage is going, as you say, those are the benefits that's going to be eroded. So at the end of the day, in the limiting case, you have to provide the good money without the benefits, right? And that is coming through good security that back it, and possibility not to run in negative equity. Okay. Now that's the first question. The second question is, who is going to provide loans? I think it's an important question, and we usually think exactly about this dichotomy between banks that they need to provide deposits and they need to provide loans, right? And it's transforming creating liquidity on one side and transforming that liquidity into credit into the economy. But I think that this is a sort of inheritance of an unsophisticated intermediary system, financial intermediation system, in which the provision of liquidity comes through deposit historically, right? But we should think that, for example, who provides credit to the economy for firms to grow, like private equity, is not issuing deposit. So, and that's come to the fact that we need to be sure that who is providing liquidity is really backing that liquidity with things that is going to be liquid. So all these, problems of the banking sector is due to a mixture of the functioning, on one side creating liquidity, on the other side giving loan, which I think is a bit of a primitive structure of financial intermediation. So if we arrive to more sophisticated form of financial intermediation in which we are able ourselves through system of verification, intelligence, artificial intelligence to verify who is really having what are the asset backing liquidity, then we can trust that liquidity, right? But if we are not able to verify, then we are always cheated. This intermediate system in which banks do this, but they take more risk than what they do, and then they come to the central bank is given to financial dominance in some way, right? So the banks can hide behind the role of providing liquidity some too much risk taking, right? Which is not appropriate for that role.
Okay, thank you very much, Pierpaolo, for this reply, and Akiva for this question. We have another question from Philippos Petroulakis.
Yes, thank you. My question has to do with something you mentioned about the unit of account. And I mean, it's clear that you don't need to be the unit of account with the currency. That's clear in history. But what about monetary policy? Like, can, the ECB or the Fed still, affect monetary policy if the unit of account is not the currency that they issue? Because I think that was like one of the initial concerns with Libra. If everyone's on Facebook and buys stuff on Facebook.
Right. There is no, okay, suppose that all prices are denominated in dollars. Can we have a well-defined currency system in another currency? Yes, the answer is yes. Provided that currency is used, just used, okay? So then you have all the elements, theoretically just the liabilities of the currency issuer should be used as a medium of exchange. Now, if prices are denominated in dollar, there is no problem to pay with the currency, right? You don't need that. For example, I can pay in Bitcoin, right? Through my credit card in Switzerland, I can pay with that. Okay, so it's a medium of exchange, and provided you use that currency as an asset or as a medium of exchange, then this grants the issuer of currency the ability eventually to control prices. So the unit of account is not important in this respect. The unit of account becomes important, when you think about reserve currency, like the dollar. So the fact that, commodity or some contracts are denominated in dollars is very important. Because if I'm a firm, for example, and I have a contract coming in revenue in dollars, this exposes me to exchange rate risk. So for that reason, I perhaps can hedge using debt in dollars, okay? So, the fact that many contracts are in the reserve currency make the currency also the currency in which people denominate other contracts, okay? So make it more important. But to understand, all these contracts in the currency are not currency, right? Are claim on currency, okay? So the unit account, the fact that many things are denominated in the unit account make the currency, that currency important, deep in the market. But the balance sheet of the issuer can be very small. Okay, so it's not, and this going back to my last point, there can be a disconnection between who is issuing the unit of account, which can have a small balance sheet, and the liquidity in the system, which is denominated in that currency, but is supplied elsewhere, okay?
Okay, thank you very much, Pierpaolo. I think we are running out of time, and that's also a good sign that people want and will read your book. And thank you very much again for being with us, explaining us all your views. And I'm sure there is more to discover into this book. Thank you for the audience for asking these very insightful questions. And we wish you a lot of success for this book and we hope to have you for a seminar, whatever, research or another book here with us.
Thank you very
Thank you
much,
very much.
Jonathan. Thank you very much to everyone, and it was a pleasure. Thank you.